Right, so um, if we understand that, what the banks do, in the market, they always create money in the market sideways, right? Up, down, up, down, up, down. They like to push the market. Damn, where's my pen? They like to push the market like this, right? Like that. Create money on the top and create money on the bottom, right? Think of it as like, a range. Like this is at 18 and this is at 12, you know. They're keeping price in between these two price points, right? Because they're bouncing off each other. This is when retail traders sell this line and retail, buyers, buy this line, right? So understand that the banks like to create money, push it sideways, create range, and then break up to take the money on top, to break back down to take the money down low. So understand that they do that, this is how we get into the market. So, once they push up, take the money, they inject so much money downwards, it leaves an imbalance in the market. And this is a sell side imbalance. So why is it sell side imbalance? Because there's nothing but sales in this area. There's no buys. And being that the market has to balance itself out, it has to come back in there. So if it has one swoosh down, it has to come back up there and fill it up, if that makes sense, right? So understanding that, we can look at the markets and play the imbalances and the institutional candles. So I have an imbalance mark, but I'm gonna, just go to the institutional candle first. So the institutional candle would be this last push down, right? Right there. It took the money to the left. And you can see the range. Hold on, let me use a different color. It's black line. All right. Bam. See the range, right?
Okay.
You see the sweep up, right? Then you see the sweep down. Oh shit. You see the sweep down, right? Which is this candle right here. Just to push the market all the way back up. So, when they first pushed the market down, they were taking liquidity on the bottom side. So in this range right here, right, market was moving sideways in between two price points. This last little wick down here, went below this red line, swept the money that was sitting underneath those, right? Once it did that, it just continued to go higher. But first it swept the money on the top side, which is that wick right there. I'm just looking on a smaller time frame. You can see the push up, which is that wick. All right, this candle right here that pushed up, came down, dropped down, swept the money on the bottom side just to trade higher. Same thing we were looking at right here. They swept the money right here, right? Travel down to travel back up. And that's all they continue to do over and over and over again. So this is going to be about, actually, looking, like, finding the imbalances and finding the institutional candles, because if you're able to find those, then you're able to, see buying opportunities in the market. So I have an imbalance marked up right now. Let me change the time frame. All right, so we're watching this live, and we see that the market was showing signs of strength on an upwards trend, right? So knowing that the market has to come back in to fill imbalances, you know, once it pushes up at a certain place, it comes back down to fill the imbalance. Like for instance, this is an imbalance here that the market came into and played out of, right? And again, we probably got it's probably another imbalance in the 30. It's the last down candle. So this is a perfect example. So right here, you have to understand that, you know, looking at these candles, price shows you what's really going on. So that being said, hold on. That being said, when price shoots up, it has to rebalance itself once the market shoots up in a direction at a very fast rate. Like this candle right here, you got this one, this blue candle. After this blue candle just came up, it just skyrocketed up, right? So when it did that, it left an imbalance in the market. So we just looking at the imbalance on the hour chart, right? Go back on the hour chart, right? It might not have been the hour, it might have been the 45 or the 30, one of them. Yeah, the 30-minute. So understand that the market left an imbalance in between this last little candle. So you would play, you know, I'm looking for the correct time frame where I actually saw it on so you can see. I think it was the 2 hour. There we go. Okay, it was a 2 hour time frame. So from this wick, right, from the candle before to the candle after, there's an imbalance. That means there's an empty gap in the market, right, from that wick to that wick, right? Matter of fact, let me just put a line. Maybe you can see it better like that. So from this wick, right, to next candle, which is that wick. So you can see that price created the imbalance. It poked in the imbalance 3 times, right? This is the imbalance, the empty space, right? Before, you know, before any of these candles were here, it was nothing, you know, that poked in there. So being in that, you know, they need to fill the imbalance back up, this is a perfect way for them to fill it in. And you see how prices, like going into it, that means price just wicked off of it. Price wicked off of this imbalance, because the body means it closed at a certain point, but the wicks just mean price traveled down there. So when prices traveled down there, you know, it pushed it back up. So that was your opportunities to get into the market. You know, if we want to set, if we're just, you know, looking for the buy opportunity, you know, we will put, you know, use our Fibonacci retracement, put it, you know, from just measure the 50% of the imbalance, right? From there to there, right? Use a horizontal ray. We put it in the 50% right there. Delete the fib. That's your 50% line, right? And then you put your long position, right? Because you're buying. right? So your entry would be 50% of the imbalance. You would put your stop like the next low, right? Because you're expecting it to respect this low to go higher, right? So that would have been a 10 pip stop loss, right? That means 10 pips means you're risking, whether it's $1, $10, $100, or $100,000, doesn't matter. You're risking 10 pips, right? And then you go for the 1 to 3. 1 to 3 would have been at the top of this high. So we just go on a different time frame and zoom in what's going on. You can see where we got into the imbalance. This is the imbalance. It's just broken down a little bit. This is the imbalance from top to bottom, right? It went in. You can see how it filled in the imbalance perfectly. Look at the bodies of the candles. You got this last price respected that line, respected the imbalance, and just literally just took off, and you got an engulfing candle. And when you get an engulfing candle, that means price could be shifting directions. So you got this nice engulf candle. That means the candle before it has like completely, filled it all the way in, basically. So if this candle is bigger, if this candle is bigger than this candle, then this is the engulfing because it, completely engulfed the candle to the left. Like, look for a sell one. I don't see one right now, but we'll get there. But basically, it filling the imbalance, right? This is when we get into our position. This would have put us in. It gave us the retracement. So knowing that, this is that last candle, the push up, right? And understand that the market just comes back to retest out of that same candle, would it be another re-entry for this position? Just because they had to balance the price back out, just like anything else. Like the last down candle, the push up, right? Price has to come back down to rebalance itself out because it left an imbalance. And that's when we get in for the test higher to go higher. That was the first entry. We didn't get in on the first entry, we got in the second entry, which is the market left another imbalance, right? This is when it was just starting to walk itself up. So another imbalance in the market, right? We can delete the first one. If we were to mark up this imbalance, long position, we could say, the 50% of the candle, of the imbalance, put your stop at the low, which is nothing but 8 pips, right? And then you would have went to the next high, which was this high that we have over here. That's that could have been a 2.5. That's not too bad, but you could have just rolled it up, just stacked on the earlier position, basically, because your earlier position was down here at this imbalance right here, right? So it's nothing but another entry to go to that one, because this is a 5-to-1 right here. So you don't necessarily have to, give another 3-to-1 if you're stacking positions to go to the next high, basically, because that's where the next money is sitting, above this high. And that would be our target to get out the market, basically. Now the 30 pips, we risk 10, 10 pips for 30, that's, 3 times our trade. We won 3 as much as we were risking, so you can wait for the engulfing candle, right? So, we had the position there. I'm gonna delete that right quick. I'm gonna move this one over. This is a position where we got in there, right? So understanding that price, if that's the last down candle before the push up, price would literally come back into that candle, the open of that candle, right? Which you can see right here that it came in. This is the wick of the candle, right? It came in to the body of this candle, right? Because now they're just walking price up at this point, because this is the last candle that swept liquidity on the left side, right?
Mm-hmm.
Then you had the engulfing candle that came next. Then you had the retest. It made a huge upward movement, right? Then it had the retest to go down into this candle again, just to go higher. And that's what we got in the market as an imbalance. And I'm gonna show you. But you could have gotten into the open where we had an imbalance that it created. So on the 30-minute, I believe. Yeah, on the 30-minute, it left an imbalance in the market. Instead of using that, I'm gonna use lines from wick to wick, right? It's the wick before, right? Then it's the wick after, right? So understand that price had to fill this imbalance back into the market. Oops. Fill this imbalance back in the market right here. And what did price do? It came right back into this imbalance, filled it up, wick, like price just wicked down very quickly. And that's what we like to see. We like to get into the market very, very quickly, right? That would have put us directly in with little to no drawdown. We were only risking 8 pips anyway, $8 to gain, to gain 50, you can't beat that. So understanding that price poked back into that imbalance, move that back over, right? So you can see it poking to the imbalance just to go higher. I'm gonna leave that right there. As you can see it on a smaller time frame. So looking at price, right? You got this last down candle. You got this huge push up. It left the imbalance in the market, right? It's what we have marked up. We could delete this one. This one's a little confusing. Wait, that one, right? So from wick, right, to wick, you got the price that came in to fill the imbalance in completely. It's just price balancing itself back up. Like if you think if you think about like this portion, right? This portion down here, right? And you think about this portion like up here, right? You got this one box, this one little line that connects them, right? So it left it before this was there, right? Before that wick was there, it broke into a new range basically. So understanding that it had the balance price back out, this is just it like literally touching the top of this range, closing out this sales, because they had to put some sales in the market here. So those were sales that they put into the market, right? They put sales into the market just to travel back up higher. And that's literally what we get into the market. That's literally price balancing itself out, the algorithm that we look for, range, balance itself out just to trade higher. You can clearly see that's like a gap in the market. So, you with me?
Yeah, I'm with you. I had to mute it, man, because there's people in my background.
Yeah, I hear the girl and shit.
Yeah, I'm about to mute this shit.
But that's just going, off of the inbox. You can clearly see what we're talking about. Like the connection, like this connected these two boxes together just to trade up higher, like price balancing itself out just to trade higher. If you understand that price literally just goes in an upwards downwards motion, oversold and overbought, oversold, overbought. Just look at it like that. This is oversold up at the top. I mean, oversold is at the bottom, sorry. Oversold would be at the bottom. Then overbought You probably won't be able to read that. Overbought would be at the top. So it's just constantly does that. So if price is overbought, it has to be, come back down just to balance itself out, just to go higher. Overbought, oversold, overbought, lower low, lower high. I mean, this is, in this instance, this is a higher low, higher high, higher low, higher high. Oops. Because if it breaks structure, which this would be considered, let's see, this would be considered the breaker structure down here. I would consider that the breaker structure. So once it breaks structure, right, if it's going, the momentum is going towards the upward side now, you're creating a higher high and you're creating a higher low just to create another higher high. That's because we understand that the momentum in the market has shifted. First we got this, big downwards push. I mean, it's honestly, this is the 5 minute, but look at this, this is just a push down to like the fake down, like they're ready to go push the market down. But it's literally just to sweep the liquidity that was under here. What is liquidity? Sitting money in the market. Because if you think about it, people brought here, people brought here, people brought here. You got people brought here, and their stop losses are below here. So what are the banks going to do? They're going to take the money to the downside, right? To take their money, to take all the people that brought in this little consolidation zone, right? They were mad happy when they got up here. And they went right back down just to take everybody back out that was trading this whole zone. Because this is like from, I don't know, 6, like 3 in the afternoon maybe to like 2 in the morning, something like that. 3 in the morning. So that's a good amount of time that money's been created in the market. Once it comes down, you want to wait for the break of structure. It broke structure, left an imbalance. Basically, that imbalance is there to create the higher low to create a higher high. Because next, if you're just thinking about it, if it's going to create a higher high, it needs to break this high, right? It needs to break this high to create the next higher high. So that's when we're looking to get into the market just to break this high. And that's exactly what it did. And that was an easy 1 to 3 trade that we got into. Like I said, we got in from down here off the first imbalance fill, which was 30 pips or something like that. So that was an easy 1 to 3 trade. We could have took it higher, but we don't want to be too greedy. So you got any questions?
No, left. No.
You understand? So you understand what's going on?
Yeah, look, but what's the time? What's the time interval that you're on right now?
I'm on the 5 minute right now, but you're just looking, overall to see where the bias is going. Of course, if you see you're in an upwards momentum trend, then you're more likely to get buys and sells. You know what I'm saying? So being that this is an upwards trend, what I'm saying, we look for possibilities to get into the market where they push the market up, and didn't quite, they left an imbalance to go higher, basically. Which is what I just showed you. The imbalances. This is the 50% of the imbalance. The red lines are the imbalance. That's the top. That's the bottom. Right? That's where we get into the market. Bam. Feel the imbalance in. Oops. Feel the imbalance in, right? Put your stop below the low. Trade higher. That was a perfect setup. Because you had to break a structure. I mean, it just shows you upwards momentum. So, being that this happened around London time, this is exactly when time and price comes into factor. You got this London open push, at 2 a.m. 2 a.m. is 3 a.m. Eastern, 2 a.m. my time Central. The push like it's going up, right? Then the fake down to entice sellers, right? Just to go back up. So they swept liquidity on the bottom just to go back up. So they literally do the same thing over and over and over again. And if you can understand that, then you can understand everything that the market is doing. So for instance, we understand what's going on here. I was looking at a couple of things before the market closed just to, see which direction, it might be headed in next week, which I'm thinking it is up. Which is down for EU. But hold on, let me delete a couple more of these and mount these little lines. All right. So now, if this was live, we can see, where the imbalance is, right? We see the imbalance. So we're expecting price to go to fill in that imbalance that it left in the market just to continue trading lower. Why? Because it's giving you downwards momentum. It's giving you a break of structure. This would be considered the break of structure. Once it broke out of the zone, once price basically broke these lows, right? So if price is, going down, we can expect price to make, here goes the lower high, here goes the lower low, right? To make a lower high, to make a lower low. That makes sense?
Say it again.
So we can expect the market to come down and take these lows. So, like I said, if we see that, they swept liquidity, right? Swept liquidity, made a lower low to make a hot. They swept liquidity to make a lower low. Now we're expecting the market to make a higher low just to make a lower low. So we're expecting the market to start trending downwards because we see the break of structure. Like this is like there's the downwards, like, right? The lower highs right there, right? Then you make a lower low, right? Because it's lower than this one. This low is lower than that one, right? So we're expecting that one to come back up to make a lower high again, right? To make another lower low, to break these lows. And that's where you can see the market basically, this is the oversold, overbought type of ordeal, but it's just basically doing it like this, if that makes sense. Just constantly coming back into that same zone like that. And that's basically what we get in for the retest. This is the higher high, right? We're not going to mark the higher high. We're going to mark the higher low. And the lower high, right? It made a lower low. It made another lower high. It made another lower low. It's just this price is going downwards. Lower high, lower low. So understanding that, you can expect the price to make a lower high here, to make a lower low here. And that's what we're looking for, because we know that money is sitting below this low. And money is sitting downwards on the downward side too. So this could be a nice, next week we could see the reversal that we're looking for to fill all of this in over here. To fill all this down, like filling all this imbalance down here, So like, you know what I'm saying? They have to fill in the imbalance. So they left the imbalance, but never filled it back in. So that could be a target for us. So, you know, if we're just looking at that as a target, it's not gonna let me grab it. Damn it. Hold on, delete some of this stuff. All right. So it has an imbalance that it left in the market, and that could be our target. Why? Because we know that they have to fill that back in, right? So we understand, you know, the market's trending downwards now. If it breaks this low, there's a great possibility that we could be coming down to take the next low, which is right here. So your lows are always going to be your targets, right? Your lows and your imbalances. So that's a target, green. That's where money's sitting, green. That's where money's sitting. Red, it already took that money. Red already took the money. So you can clearly see what I'm looking at here. So I want price to actually go. Where's my tool? There you go. Go back into this imbalance to fill it in, to just go down lower, because this is the imbalance that is filled in, that needs to be filled in. So that's where we get into the market. You know, if we were to, you know, play this for real, right, we would use our fib, right, put it at the low, you know, wick to wick, right? Then you got the 50% of the imbalance, right? You use a horizontal weight rate, put it there, delete the fib. This is our entry, right? 50% of the imbalance. We could put our stop at the top of the high because we don't go higher than that. And that would be our setup. And we would look for a 1 to 3 rate. We're looking to go down to these lows, this low right here. So that would be where we would get into the market and get out of the market in a picture perfect setup like that. You can clearly see, you know, this is the 50%, right? 50% is the white, the black line of the imbalance. 2 red lines are the actual, that's the top of the imbalance. That's the bottom of the imbalance, right? You can clearly see where the imbalance is in the market. Put a rectangle over it, right? That's your imbalance in that one candle right there. So that's when we can expect price to either go up till it touches this candle here, or just into the 50% of the imbalance. So you could play another position. You know, you could have your entry, you know, there's multiple ways you can look at the market. You can have your entry here, and to fill the imbalance up to come into this wick of this candle, because once it just needs to come back up to a balanced price back out to go lower. So it could come up there to touch the wick, or fill in the imbalance just to trade lower. You can put your stop here, but this is when you use smaller time frames to get a better stop, or to get a better, to get a better stop. This is on the 15. We can go down to the 5. You know, we still have the imbalance highlighted there, right? Still still a clear imbalance. You can put your stops above here, which is nothing but 6 pips, right? Because you're not expecting it to actually go above that high. You're just expecting it to make a lower high, just to create a lower low. So, you know what I'm saying? It could fill that up, you know, fill that imbalance in, you know, just to trade lower. And that's would be a nice sell position. Let me move this, you know. You see the clear imbalance, right? It's a gap. It's clearly a gap, and they need to fill that in. So like this is a sell side imbalance. So what do they need to do? They need to put buys in the market. So they need to put buys in this area. And that's when we get in, you know, and it just fills it up just to trade lower. Like literally, this is what we wait for. Like come up, right? Put us in. You see the break of structure, right? Come back up to the retest to fall lower. Why is this a break of structure? Because it fell lower than that low. Then when we get in for the retest right there. That makes sense? We just think about candles. You know what I'm saying? This is another long candle. Create the imbalance as it come back up into that imbalance. And it just does that, you know. This is where you get in every time. You get in right there. It's supposed to come up here, but you know, you would get in right there for the retest. Come right there, get in for the retest. Every time it creates an imbalance.
Okay.
So that's basically, you know, really what an imbalance is. And, you know, you got buy side and sell side imbalances usually coming after the big push of the institutional candle, or, you know, the expansion upwards to create a new zone, basically, which is this is create a new zone. I mean, a new range. I'm sorry. Create a new range because this thing is breaking down. So it creates a new range. Creates a new range, moving back and forth, right? Back and forth to the, you know, creates money on both sides, right? Then you get the push up to fill in the imbalance, right? To get the push down. That makes sense? It swept the money here, coming down to sweep that money down there.
Okay.
Because this right here put you in a different trading range. It was the first trading range that I was in. So now you're just looking for price basically to balance the two ranges out, two boxes. Remember the two boxes? Basically balancing itself out.
Okay.
So, like for instance, this would be like a range, right? You make that red, and this would be a range up here. You make that, you know, yellow. And you can see the orange, the green. The green box is basically what connects those two ranges, right? So it needs to come back up to fill that in, to balance the price out, just to trade lower.
Okay.
That makes sense?
Yeah.
You got any questions?
Not right now.
All right. So I'm just going to look into a couple institutional candles. We kind of showed you imbalances. So now we can look at some institutional candles. And the institutional candles are basically where the banks are behind. So they're sitting behind this candle basically. So for instance, this would be considered an institutional candle. This white, this bearish candle. Why? Because the institutional candle, you know, the banks are behind it because they like to sweep money. And after that, they give a big push up, which, you know, the sell for the buy. They sold it down, right? To just buy it back up. That's the sell down. That's the buy up, right? So we understand that, you know, that box is the institutional candle. You know, we can play off the institutional candle, which you can see the wick came back into the institutional candle, which is this candle right here, right? They just, you know, basically closing out that sell position. They open to go higher because they pushed the market up so much, right? Like if you had two trades in, you press the sell button, it drove it down, then you press the buy button at the same time, the sell is going to be a negative, right? So you need to come back down to close that sell position, right? This is the close to the sell position just to go higher. Sell, buy, close my sell position, buy back up. Now I'm in like double profits. And this is why the banks, take all our money and use it to put in the market, to manipulate the markets, because they know they can be fined for it, $50 million, but they'll be making $60 million while they do this. So it doesn't matter if they get fined or not, because they know that they made more money, after the
Manipulating
fact,
the market.
manipulating the markets, because they took everybody's money. This green line is where they took everybody's money. That pushed down. This is why the institutional candle, it pushed down. It swept all these lows, low, right, low. Swept all those lows just to trade higher, right? It gave you the engulfing candle, right? Engulf, came back down, touched the candle just to trade higher. And that's basically what they want. All they do. That's basically all they do. So we'd be looking for that imbalance to get filled in, which is about 100 pips from where we're at right now, or from our entry, if we're looking to get in. Because this is considered the breaker structure, to be honest. I mean, I would like to see it like this low right here broke all these lows that were sitting above it. It broke all these lows. It went below all these lows, so it broke structure to the downside. So that means this thing could be continue to go lower. You know what I'm saying? Because now, like I said, if it's breaking structure, that means it's going to create a lower low to create a lower high to create a lower low. And then you can just expect for it to come down to filling this imbalance. Honestly, it could come down to this candle right here, because that last push down before the push up, you can see where the imbalance is in the market, right? You see, if you just put it at the wick, right? The wick above, the wick behind, and the wick above, right? That's the imbalance that you have in the market. After this is probably a 4-hour engulf, maybe, or maybe a daily engulf. Yeah, it's a huge daily engulf candle. This is a daily engulfing candle, so we can at least, like, after this candle.
Look. Why you call it daily engulfing? Like it's like.
Because it's a way bigger difference, because it's a daily engulfing candle. So that means the day before it engulfed all of the sales that were before it. So this is the day before, right? Right there. Then you have the candle that came beside it that just pushed this market all the way up. So we know the banks could possibly be behind this candle here. Why? Because it's the last sale before the huge push up. So where can we expect them to go back into? We can expect them to go back into the wick of the candle, which would be right here, which is still in our imbalance that's right here. It still has to fill in that imbalance. This is a daily imbalance, so we know that has to be filled in regardless, right? And it could come back down to the open of the candle as well, right here. So you got basically 3 points where it could, get a retracement off of, but it's all the way up there right now. So, even if we're considering, how many pips that is to come down here, that's 100 pips. This is 160 pips, and down here is 177 pips. So, this looks like, it could be coming down to filling that imbalance, to be honest, just to trade higher. to make a lower high just to make a higher high. Basically respecting the structure that is in, because it's on the upwards trend. You can see how it's on the upwards trend. So that's this is on a daily time frame. So these are big points. These are more considerable points in the market, where more effective points in the market where price could react off of, because it's on a daily time frame. Bigger time frames are always king. They're always going to give you more of an impact over the smaller ones. So this looked like it can get a daily engulfing candle down here as well. I mean, where we're at today. Well, if it continues, we didn't, but like this, if this would have filled in this candle and gave you like a bigger candle, that would have been an engulfing candle, right? If we just make this white, just to resemble what I'm talking about, right? If it gives you an engulfing candle like that, let me put it beside it. How about that? It gives you an engulfing candle like that, right? And then it gives you like another push. I mean, honestly, you don't even need another push. Once it engulfs this, like gives you a nice engulfing candle like that, then you can expect you want to get in. Where's my horizontal ray? You want to get in at the open of this last candle, right? So you would expect price to travel back up just to close out that sell or that buy position they had. So this candle would travel back up just to touch that candle, just to travel back down.